Right now, the United States military is quietly abandoning its most expensive weapon systems in favor of something new. The Top Gun era is officially over, and these multi-billion-dollar fighter jets are going to be put on the shelves. And a few companies are well positioned in this shift towards autonomous drones and robotics. So here's the math behind this urgent shift in defense technology. Right now, the US and its allies are using $4 million Patriot interceptors to shoot down $20,000 autonomous drones. That is an economic loss ratio of 160 to 1 on every single time they use one of these things. The Pentagon knows this is mathematically impossible to sustain, and they are about to reallocate tens of billions of dollars in record time to new industry players. Traditional military technology is just too expensive. The mainstream financial media is covering the defense sector as if Pentagon's budget is going to continue expanding indefinitely and things are going to be the same as usual. Money is going to flow to the exact same contractors since the Desert Storm era in 2002. But they are wrong. And this is because the Defense Department's top secret Replicator initiative isn't buying more legacy hardware and expensive military weaponry. It's mandating procurement of tens of thousands of low-cost, AI-driven autonomous swarming drones by the end of 2026. And these institutions are already looking at the potential winners in this new growing market. So, how fast is this shift actually going to happen? Right now, in 2026, the global military drone market crossed above $54 billion, and it's heading straight for $100 billion. We are witnessing a transfer of capital from these legacy defense stocks over to autonomous robotics and military software companies. In the next 5 minutes, I'm going to break down these exact numbers, what kind of growth we're likely to see coming up, and the specific tickers that you need to track in your watch list. So let's look at this explosion in demand. In 2024, the military drone market was a respectable $42 billion sector, focused largely on large drones that do intelligence and surveillance work. But fast forward to where we are right now in 2026, and we're already surging past $54 billion and rolling out new types of drone technology. This growth is coming from mass swarm autonomous drones, and by 2034, annual deployment will exceed over 1.2 million drones per year. So how do you go from building a few very expensive drones to over 1.2 million in a single year? You build them out like artillery, fast and cheap. But the cost structure is turned upside down for these companies. An F-35A costs $82 million off the line and over $40,000 every single hour that it flies. And a Patriot interceptor costs roughly $4 million for each and every one that's used. Now, an autonomous mass swarm drone costs between $25,000 and $50,000, the cost of a Toyota SUV. If one side of the conflict launches a swarm of 100 autonomous drones costing $2.5 million, the other side is using traditional technology costing over $400, $500, $1 billion. The numbers just don't make sense anymore. The military doesn't have a choice. It must transition to low-cost, autonomous systems. So this explains the trade opportunity that's coming up in the market. By 2040, defensive autonomous drones and robotics will capture nearly 48% of total defense budgets. Manned heavy combat platforms like jets, tanks, other types of traditional equipment is going to drop from 68% to just 31% of these defense budgets. So what is going to happen to these massive multi-billion-dollar aerospace tech giants when their primary revenue starts to shrink by more than half in just the next 15 years? Why can't traditional defense companies like Lockheed Martin and Northrop Grumman just build out cheaper drones? What is stopping them from just competing in that market? Well, it's the classic investor innovation dilemma, and this is driven by the contract structures in the defense sector. For half a century, every contract was a cost plus a margin. The higher the cost, the higher the profit. If a jet costs $1 billion to develop, the contractor gets reimbursed for every single expense plus a guaranteed profit margin of, say, 10 to 15%. Now, imagine the government coming back to you today and telling you, we want to stop building $100 million jets. We no longer want to give guaranteed 12% margins. And instead, we want you to manufacture millions of $30,000 drones at a fixed price. That is going to change things up dramatically. It's going to cannibalize the revenue of these big defense sector aerospace giants. Their massive factories, their heavy overhead, and their sprawling supply chains are going to have to be totally revamped to a new low-cost, quick production model. So how do these drone swarms actually operate? How do they work? Do they require 1,000 people sitting hundreds and thousands miles away behind a computer screen? Well, today's modern drones don't require any human involvement at all. The breakthrough isn't in plastic or carbon fiber or electric motors. The construction of these small-scale drones is basically like a commodity. It's just hardware and physics. The real value is in software. When you launch 200 swarm drones, they form a neural network in the air. If electronic warfare jams 5 of these drones while they're in the air, the other 195 drones will instantly recalculate their flight paths, plan the objectives, and execute their mission without a single millisecond of downtime. Let's look at who controls the North American market today. On the hardware side, we have pure play companies like Kratos Defense, ticker KTOS. They build very low-cost drone technology, specifically to fly alongside fighter jets as a wingman. Next is AeroVironment, ticker AVAV. They dominate the tactical munitions like a switchblade, which are being produced by the thousands for each and every one of these drones. Meanwhile, legacy giants like Lockheed Martin and Northrop Grumman are forced to partner with small, nimble software companies and startups just to stay relevant. So let's look at the breaking markets playbook for this changing market. You can trade this transition through 2 distinct scenarios. Scenario 1, long autonomous hardware and AI pure plays. If the Department of Defense procurement under the Replicator initiative accelerates faster than expected, these pure play drone manufacturers and defensive AI companies will experience the fastest growth. So here's their core tickers. We have Kratos Defense, ticker KTOS, AeroVironment, ticker AVAV, and Palantir Technologies, ticker PLTR. And of course, Palantir is the primary software company that is contracted to the Pentagon for AI and operating systems. Scenario 2. We long the supply chain. If you want to avoid exposure to a singular defense company, or if you have ESG reasons, you can still own the underlying bottlenecks. You can target the hardware components and you can target the suppliers or just invest in a broad ETF. These are Teledyne Technologies, ticker TDY, Umbrella Inc., ticker AMBA, and the iShares Aerospace and Defense ETF, ticker ITA. Teledyne supplies the infrared thermal sensors that give the drones their vision, and Umbrella provides low-power edge AI chips, allowing drones to navigate without GPS. While defense contractors retool for autonomous technology, one unlikely tech giant will be supporting it all. Right now, Amazon is executing the single largest infrastructure bet in corporate history, committing around $200 billion in CapEx to build out AWS's AI data centers. And that's just for 2026. And they've already signed deals with the Pentagon to supply AI and services for the new military complex. That spending spree just cut Amazon's free cash flow by 95%, leaving Wall Street completely divided. Is it too much? Is it too soon? Click and subscribe and ring the bell for our next video on the massive Amazon AI build-out.